All right, so last time we looked at some issuance numbers. So um, this right, that was this content. So this section is really more about the market itself and how it operates and how it's regulated. Um, so there's two different kinds of bonds. There are bearer bonds, which um, demonstrate ownership by possessing the bond, and that's in contrast to registered bonds, where the owners of the bond are recorded in a registry. And so right, if you've ever seen, like a classic caper movie where they break into some safe and they run off with bonds, right? That wouldn't do anything for a registered bond, but it would absolutely do something with a bearer bond, right? You could just produce the bond and show, by holding the certificate, it means you have it. So this means in practice that bearer bonds are usually held in careful custody by banks that have expertise in protecting bond certificates, and so the institutions track who has a claim against their bearer bond in their vaults, and then when they trade, they can, the bond certificates don't have to move; they can just stay with the bank in which they're deposited, and then the ownership can just change in the bank's registry. So, bearer bonds are attractive for privacy and anonymity, and naturally then, as well for tax evasion, right? Because those bond interest payments may not be reported to a relevant tax authority because they don't necessarily even know what the relevant tax authority is. So yeah, the bulk of international bonds are bearer bonds. I think it's 80%. So with any foreign bond, the security regulations that apply to that bond are the country in which it's issued, right? So if I am, a French company issuing a bond in France, even though the currency it's denominated in is US dollars, then French security regulation will be relevant there. And that actually matters because U.S. security regulations are very stringent. They're actually somewhat onerous, and it's expensive to comply with American securities regulations. And so companies using to raise dollars in the Eurobond market will often issue in a different, more preferable domicile, like a different country that has a more workable securities regulation, right? So in the U.S., U.S. domestic companies don't really have that kind of flexibility because, right, if it's a U.S. company issuing debt in dollars, that's just a domestic security, so it's going to be regulated by American domestic securities issuance. So they could have a foreign subsidiary issue Euro bonds in dollars in a foreign domicile, but then, that income would have, so then that money would need to be transferred to the U.S. firm somehow. So yeah, a point being, though, that there's a wide variety of securities regulations all over the world, and that the debt issuance depends on the country location of issuance, and so there's some flexibility even. So for foreign firms, there's some flexibility in where they choose their country of issuance for their debt. In the U.S., so U.S. investors can participate in dollar-denominated debt Eurobond market, but there's a 40-day restriction, which basically ensures that those securities have been trading around enough that a price gets established, and that we don't, with primary issuance, you have to worry about basically fraud, right? If I issue a security with false documents, collect a bunch of money, and then disappear, securities regulations have to carefully protect American investors from that kind of thing because it's very easy to do. It's not easy to get away with, but it's easy to do. And so a security that's been trading around in the secondary market for 40 days, if it was a scam, would probably already have gone to almost nothing by the time the 40 days has expired. And people would have had, other parties would have had time to do due diligence. So there's not one point of failure, right? If you're in the primary market, all you have to do is convince one org and you can get their money. In the secondary market, you have to convince the whole world, right? And if somebody finds out that your security is fraudulent by doing some good sleuthing, they can go public with that information and make a bunch of money selling that security short. So the seasoning of Euro bonds for the American investors is on purpose designed to protect American investors from the primary market in Euro bonds. So there's a couple of securities regulations that ease bond issuance that are relevant. So Rule 415, instituted by the SEC, allows a shelf registration. So basically what this is companies can say, okay, I'm planning on issuing 10 million shares of my company stock, or 14 million bonds at current market prices. But and then they get permission to do that issuance, but they can put that issuance quote on the shelf, meaning it's not happening yet, and they can take secure. It's like an inventory shelf is really what it is, right? So you have these newly minted securities that you have permission to issue, and so you can reach under the shelf, pull the certificates off the shelf, sell them, and that constitutes an issuance. And the SEC will recognize that while the securities are on the shelf, they don't exist for the purposes of calculating securities outstanding or reporting on total debt outstanding. And so it means that it's a way to economize on needing to get the SEC's approval. It really facilitates companies doing regular issuance of small amounts of securities instead of needing to do a really big issue all at once and getting it approved by the SEC every time. So shelf registration is important. And then a company with a shelf registration could, issue, they could daily issue new bond securities if they wanted to, because they just can pull some off the shelf and sell them. Another important rule is 144A. So that allows buyers in the United States to trade in private placement issues. So specifically, this is okay, and this matters a lot for bonds because so let's say I'm a mid-sized enterprise. I can go to, say, the California Public Employee Retirement System and say, hey, I'm doing an $8 million bond issue. Do you want to buy the entire thing? If you do, we'll give you a little bit of extra interest rate because we don't have to do all of the expensive compliance work of meeting the publicly traded securities requirements. And so for qualified institutional buyers that buy these private placements, where often it's the entire issue or a large fraction of the issue, they can get excluded. So there's no benefit to the company to having a qualified institutional buyer for some of their issue and then selling to the public for the rest of the issue, because then they would have to comply with publicly traded regulation. So if they're going to go the qualified institutional buyer route, they'll want the entire issue to be placed with the qualified buyer. And in that case, they can avoid some of the more stringent disclosure requirements because those institutions are qualified to do their own due diligence, right? They can say, okay, well, for us to give you money, we need you to answer these 18 questions and have them, verified by your auditor or whatever their own standards of due diligence are. They don't need to rely on the federal standard, which is most likely much stronger. So it's more expensive to comply with and better about catching inadequacies. So another kind of bond issue is a global bond issue where the bonds are simultaneously sold all over the world. And which kind of creates an interesting sort of situation, because if you have a dollar denominated bond that right, is paying dollar interest and dollar principal, and is issued in collects dollars, and it's an American company issuing it, that's a domestic bond. It's not an international bond. But if it's a global bond issue, then that bond is being offered to the whole world. So some portion of that bond will end up American, and the rest of it will end up international. And so what happens is the global bond, basically a portion of that global bond issue gets allocated to being a domestic bond. And so a Yankee domestic bond, and then a portion elsewhere as the euro dollar, right? So because it's issued globally simultaneously, there's basically an estimate of the American scale of interest, and then it gets allocated as partially domestic, partially international. Okay, within the bond universe, there are many different types of instruments that has to do with maturity dates and floating versus fixed interest. Specifically, of these five major categories, there's a couple key differences. So straight fixed rate, so this is a bond paying a specified interest payment every period for the life of the bond. Those payments are annual. That's in contrast to domestic bonds, which typically pay semi-annually. And you've got a fixed payment, and the payoff is the currency of issue of the bond. And those are the most popular. Floating rate notes are similar, but they pay more frequently, and they have an interest rate that floats with global interest rates. Convertible bonds are typically fixed rate debt with the additional feature that if equity of the issuing firm is valuable enough, the owner of the bond can elect to be paid in shares instead of in cash, and it's in a specified number of shares, not in a specified amount, value of shares. And so if the shares do well, then the convertible bondholders do very well. Straight fixed rate with equity warrants. So this is a fixed rate bond, but with this extra opportunity to buy some shares at a reduced price. So that's kind of a kicker to make, hopefully to get the interest rate down a little bit or to make the deal happen. And then dual currency bonds are kind of their own thing. So talking specifically about this type, so the straight fixed rate are the most popular, and there's annual payments. A euro, US dollar, British pound, and Japanese yen are the most common currencies denominating straight fixed rate bonds recently. This is the common one. So vast majority of new international bond offerings are of this type. The euro medium term notes are fixed. This is a type of fixed rate note, but it kind of has some interesting features in the way it's issued. So they have a fixed maturity and pay coupon interest periodically, but unlike a bond issue where you sell the whole thing all at once, euro medium term note issue is sold on a continuous basis through a facility. So basically, you have this facility with a bank, and then whenever you need to borrow money, you just borrow money, and they sell notes to raise the money that you're looking for. So it allows companies to sort of borrow flexibly over the length of time. So obviously, there's some compensation for the managing issuing entity to handle all of the periodic issues of these notes, but it allows, rather than having to specify the exact dollar number of the bond issue like you would in a typical bond issue, you sort of specify this large dollar number issue, and then but there's no requirement to use it all or to use it so much of it by any particular amount of time. So it's very flexible in terms of raising capital. Floating rate notes work like fixed rate, but they float. There's a reference interest rate. It used to be the London Interbank Offer Rate. for the most part, but there was a scandal because the London interbank offer rate was basically the rates that large London banks would lend to each other. But the problem was to find that out, they would do a survey. So every day they would call the banks and say, hey, what'd you lend at and borrow at today? And it was just a small number of people that reported that data. And so what happened was, all bond prices depend on interest rates. And so small changes in rates would have effects on bond prices, which would then affect the current status of bond traders' portfolios. And so what they got in sort of this back scratching arrangement where they would report interest rates that deviated from the truth so that their friends could, so like if you had a friend in another bank and it was getting close to hit the end of his reporting period for his portfolio and he was down a little bit and was worried about getting fired, he'd call in a favor and everybody would report a little bit lower interest rate that day. And then the bond prices would all go up and his portfolio would look better and he wouldn't get fired. And then they would just report back normal the next day. So it's just a temporary price spike because somebody was just... So again, it would be like the entire planet's worth of bonds are getting reevaluated for their total value because one guy wanted to not get fired. It was a big scandal. And so they changed it to the overnight offer rate, and this is so this rate is based on repo. So repo are securities where you pledge collateral to another entity, and then after so many days, it's usually a day or two or a week or whatever, you get it back, and then there's an interest rate that those pay. It's kind of like a private lending arrangement, and those private lending arrangements have interest associated with them. So that's tracked within the clearinghouse that handles those transactions. So it's actual data instead of a phone survey. And that's the replacement. So it is much more methodologically secure than LIBOR, but probably LIBOR would have limped along fine for a long time other than the scandal. But now it's gone and it definitely won't. I mean, we won't go from the actually using real data back to a phone survey. That doesn't make sense. So the big reason to do floating rate notes is it preserves principal because, when interest rates go up, bonds go down, and when interest rates go down, bonds go up. But if the interest rate in the bond goes up and down in the exact amount that interest rates go up and down, then the principal stays exactly the same. And so, it's really annoying if you have a whole bunch of money and then interest rates move against you and you lose a bunch of value. So if floating rate notes are attractive for, let's imagine I did a big bond issue because I knew I locked in this project and in 2 years we're going to start construction. I issued a bunch of money to lock in the financing, make sure I could get it. So I just want to set that big pile of money somewhere and have it not change in value over time. I don't want to do cash in a bank because those interest rates aren't very good. So I'm going to do a floating rate note, earn some interest. The amount of interest will flex, but the principal will stay put. So I don't have uncertainty about actually then using it for what I set out to use it for in the first place. So yeah, floating rate is really good for preserving capital. These equity-related ones, right, I mentioned before, but you have either a convertible where you convert the whole bond over to equity, or a warrant where you keep the bonds, but you get this extra equity kicker. Either way, you end up with potentially some equity in the issuing from the issuing entity, and it's really a way to help riskier firms successfully do bond issues. Right? It's they're not really worth it because of bankruptcy risk unless there's also upside, right? Upside potential to having equity do well. So both of those arrangements provide some equity to organizations that take the risk on taking on these higher risk bonds. So a dual currency bond, those are the less sort of unusual type. It's a fixed bond issued in one currency that pays interest in that currency, but at maturity you get a different currency. So yes, you can imagine, right? Let's say I issue a bunch of debt, and saying I'm a Japanese firm and I issue a bunch of debt and right, I issue a bunch of debt, but I just collect dollars naturally from running my business, so I'm going to choose to have debt that pays interest in dollars, but then at maturity, I want to retire the bond with a bunch of yen because I have enough dollars on hand to pay interest payments, but I don't have enough dollars on hand to pay a big principal payment in dollars. And probably what's happening is those bonds are getting retired by another bond issue, which would also likely be denominated in yen. So basically, you could do a new dual currency bond issue, collect a bunch of yen, pay off the old dual currency bond, and just have a place to put your dollars all the time. So it's a dual currency bond is just one in which the interest payments and principal payment are not the same currency, but there's good reasons why that would be the case. And that's an example. So issuing bonds, having good credit is important. So there are rating agencies that rate organizations on creditworthiness, and so you have AAA, and then AA and single A, and then BAA and BA and B. Right? There's and every or kind of as its own thing, but they usually, they all go A, B, C, and on down, and then there's some difference in how they represent, like really A and mostly A and kind of A. But anyway, so these rating agencies do fundamental analysis, and for a service will tell you what the credit rating is. So basically you subscribe to this information service, and then they tell you credit ratings. And that's important. So companies will also hire these rating services to say, okay, how much debt can we issue and retain our AA credit rating? And they'll try to, keep it that way. There are some portfolios that don't allow non-investment grade bond purchases where investment grade tops out at BBB. And so a company, nobody wants to buy BBB debt that's brand new because there's a chance it could go to BB, and if you're investment grade only fund, you got to dump it. That's really obnoxious and expensive. So they'll, for new stuff, they'll want to buy AA, so that way it's safely bigger than BBB. And so companies try to hang out at AAA, single A if they can. So this is just an example of how the S&P, that's an example firm in the ratings world, does credit assessment. So this is for sovereign debt. So this is a country that's issuing bonds. So you can imagine, say Liberia issues some federal government debt, and they want to have S&P rate that debt, and so they have this process. So they look at an institutional and economic profile of the country itself, and then they'll do a performance profile with multiple features, and then combine that into so those two branches of research combine into a rating level. So that's sort of an overall rating level, and then they do a little up or down for a couple other things, right? So the foreign currency overall sovereign rating can affect it, that these supplemental adjustment factors. There's a lot of these things, but that can feed into this. You start with the base level, feed in the little extras, and get to the official foreign currency rating, and then you can get a notch from the local currency rating. So, and again, we can have, right, if I'm issuing a euro bond, I've got the sovereign rating of the currency and the sovereign rating of the issuing nation. So there's a couple layers there. Okay, so to get these to happen, we need a primary market and a secondary market. So primary market is when you take bonds and sell it to a buyer for the first time. And so for euro bonds, there's a lead manager who solicits interest, makes sure there's enough people willing to buy it, and then an underwriting syndicate that brings the bonds to market. So you have usually banks or large clients that are willing to buy all the bonds from the issuing firm, but usually just on a temporary basis. So they might just keep them forever, but they often will resell them right away too. So they work together with underwriting syndicate banks and borrowers and lenders and the borrowing lead manager to come up with terms. And so once they get all that commitment, then they get the underwriters to buy the whole issue at the specified price, and then they'll basically sell those on at a 2% discount, and so they pocket that difference. And so again, so that means that all in, you probably have a 3% cost to raise money. 3% cost to raise money in the bond market because of paying underwriting fees. Secondary market is different, right? So this is after the bonds have been issued. Bonds can trade in the secondary market. The primary, so Euro bonds, secondary market, over-the-counter market, principal trading in London. So again, stocks, most popular stock markets are in New York, right? Most popular derivatives and commodities markets are in Chicago, and the most popular Euro bonds market is in London. So we say that London is a global financial center. That's, really one way in which that's true, that people trading Euro bonds in the secondary market will often, go, quotes, take their business to companies in London. So market makers that have inventory in Euro bonds will quote bid-ask prices, and then brokers will work with clients to make transactions between different inventories. So it's really it's a pretty opaque system. You don't know. You have to call around to find out what different prices are. You'll get, if you're looking for a particular kind of bond, you have to have an organization that has those bonds in inventory, so you have to kind of ask. So it's really kind of old-fashioned in the way it operates. But that's partly because a lot of bonds never trade, right? They get issued, and they are bought by a principal buyer and kept to maturity until they die. So it's not like stocks where they trade all the time. Some bonds trade frequently, but many bonds may never trade in their entire life. So there's less liquidity, which makes having, the kind of sophisticated market infrastructure that you see in the stock market make less sense in the bond market, right? Why have a whole crazy, awesome, multi-millisecond timing system for something that never even uses it? It's not cost effective. So the securities clear from a couple different, Euroclear and Clearstorm International. They're two clearing systems that clear these bonds. So when I say clear, it means handling handling who owns what when. So this is having a bond in a safe somewhere. We keep track of who owns it using software systems and clearing protocols. So Euroclear and Clearstream International are two major players, the biggest in handling those. And those firms are in Belgium and Luxembourg, right? Which again makes sense because the U.S. doesn't need Euro bonds as much as the European Union member countries do. So there's a lot more need there, so it's sort of a center of activity for that. But in general, you have depository banks that have physical security of the certificates. They track ownership, and then the bonds don't move. So about 90% of Eurobond market maker inventory is deposited within the system of those two. And they can, so they'll handle distribution of a new issue, right? Like they'll direct here's the stack of certificates, indicate in your systems who owns these. Here's the list that, right? So it's sort of creating this registry, but instead of having it at the bond level, it's at the custodian level. And then they'll handle coupon payments, right? Knowing having all the certificates and then knowing who the owners of the certificate are, they can clear interest payments, right? So the company would pay the clearinghouse the total coupon payment, and then they would pay out to whoever happens to currently own the bond and is entitled to the interest rate. So that's handled. So like who owns it and who gets the payment is handled by these private organizations. There are international bond indexes of various types. You can go track bond prices change with, global political instability, interest rate shifts, and inflation expectations, all sorts of stuff.